What a year it's been. Many of you were here last year with us, and at that stage, we had just had like a year where we had constant stage 4 to 6 load shedding. We were in the run-up to the elections, so we had Frans Cronje speak here with us, and actually his polls and forecasts were surprisingly accurate for what ended up happening with the election. So it's just been a crazy year. We've got a new US president that's really ruffling feathers everywhere. It's been an exciting time to be an investor, so thank you very much for being here and joining us here today. What I want to cover today is just speak a little bit about the past year, what worked well, what didn't, where did the performance and the returns come from, and then at the end, spend a little bit of time on the things that's on our mind currently. What do we see happening in SA? How big has the improvement been post the election? And then touch on some of the global trends, specifically AI, that's a trend that we're very excited about in the year ahead. You'll see at the bottom of all the slides, we've got a cell phone number there. So as I go through the presentation, please think if there's any questions you have on the slide or in general, you can start sending the questions through. We're going to follow this up by panel, and we can address many of your questions during the panel discussion with Justin and David. So firstly, just the intro slide that most of you will know very well. We're entering our 27th year this year. We're the longest running and oldest South African hedge fund, also the largest and hopefully best performing. And I think we've got industry-leading alignment of interest. We're all major investors in the fund right alongside you, and we intend to keep it that way for many years to come. So let's go on to the performance for the year. It ended up being a really good year for our funds. I'm very pleased with the outcome. The high growth fund at 22% return for the year versus about 13% for the balanced fund category and for the equity market. And I think what's particularly pleasing is that even the 3, 5, 15-year numbers are all kind of above 15% per annum. This is really what we hope for and we aim for. We're not going to achieve it every year. We're going to give it our best. I'm sure there's going to be years where things are tougher, but this is certainly what we aim to deliver for you over time and what we work very hard for. And I think that the beautiful thing about investing in general, and specifically a hedge fund where we manage the downside, is if you can keep putting runs on the scoreboard without big drawdowns, these kind of consistent returns end up giving you kind of a picture like this that really just compounds on itself. And I think high growth, we're just below like 180 times money now since inception. I hope we can get to the next major milestone potentially in the year ahead. And I guess it just shows you the gap with the market and the overall balance fund category just keeps widening, and it's just avoiding those big drawdowns and putting consistent runs on the scoreboard. If I look at pure hedge, it was also, I think, our best year in many years for this fund, doing 16%, which I think is almost abnormally high for a market-neutral fund. And it's a function of a year where I think we had many insights that end up playing out correctly. And also, I think we did a good job managing the drawdowns, and there weren't any major losing positions in the year. And I think having few losers always is a key part of having putting a good year together. I think if you think about what to expect for this fund, the 3, 5, and 15-year numbers all around kind of 11, 12, 13% is hopefully something we will continue to aim for. Again, you don't know what happens in any specific year, but that's certainly what we try to deliver for with this fund. And again, the compounding adds up. You'll see very, very close to the 100 times for this fund. I think it'll be something we would be extremely proud of if we can hit 100 times money in a fund without ever having a down year, and I hope we can put that together this year. So I think I touched on avoiding big drawdowns and diversification, and I think that is a key thing that we look to bring to client portfolios. I think we look at the market and the opportunity set somewhat differently from most investors, and because of that, we find ideas that's not correlated with the overall market. And on this graph, you can see for the last kind of 20 years, we've got all the down months in the JSE, and you can see that actually in a whole lot of those, probably the majority of them, pure hedge was actually up. And last year, particularly pleasing to me, is there was 4 down months for the market, and we were actually up in each of those 4. And that's really the job we want to do. We're not always going to do it maybe as well as this. We're certainly going to try, but I think that is the value that a hedge fund can add to a portfolio, is buffering clients in those drawdowns and then still hopefully generating strong returns over time. I think this is quite a similar picture as just over the last 10 years, a risk-return scatter plot of all the funds, all the major funds in the SA market. And you can see there's a little bit of an efficient frontier there. Kind of the x-axis is the standard deviation. So as we take more risk, expected returns should tick up slightly, which is it's quite a flat line for the SA market. and you can see there's two clear funds that stand out. And I think the key for us is we want to be higher on return, but at the same time, we want to be at the low risk spectrum of the category we compete against, which I think pleasingly has played out over the last 10 years and 15 years. All right, so let's get into the juicy stuff. What kind of moved and generated returns in the last year? So Fortress, after being a very big winner last year, was again the major return contributor. We spoke about it a lot in last year's annual letter and again in this one. I'm not going to say much more about that. I think Justin's on the panel, and if there's questions, we can cover it on the panel. But I think it's very pleasing that this one played out again in the last year, and I think it's quite a nice one because it's one where the return would not have been there without our involvement. And Justin spent a lot of time on this one, having calls with people, having meetings, and it's to some extent making our own alpha. Obviously, management played a key part, and finding the right opportunity at the right valuation up front. But I think it's quite nice that this wouldn't have been there without our involvement. I think we traded China quite well last year. It used to be a material part of the portfolio back in 2019, 2021. Then we had a very tough few years in China where Xi really clamped down on a lot of the Chinese shares. And I think we reassessed how we invest in China and became quite a bit more conservative on when we buy Chinese shares and when we sell them. And I think last year, despite this conservatism, there was a great opportunity to add China to the portfolio, and it worked out very well. Outsurance is on here. I think it's the third year in a row that it's one of the major contributors. It's a business we love. It's just been an amazing SA success story. They expanded to Australia, huge success there. They're now building a business in Ireland. It's just an unbelievable SA company. And then Pepkor and Lewis is really taking advantage of how cheap SA valuations were in sectors like retail last year and how the economy improved somewhat since the election. There's two losers on the slide. Pinduoduo, we spoke about last year, was actually a big winner for us in 2023. Unfortunately, I think the Chinese economy slowed a bit, and this business felt the brunt of it. And I think there was also some concerns before the elections that Trump would really increase the tariffs on Chinese things, which interestingly for now, Trump's been more focused on Mexico, Canada, and Europe rather than China. And I think the Chinese shares have therefore had quite a good year to date. I mean, you've got to stay awake with this, but it's a volatile one. And Evolution Gaming, which is a software provider to the global casino operators, online casino operators, things like blackjack and slot machines you play online. I think growth just slowed a little bit, and unfortunately the valuation derated, but it's still over time been a reasonable contributor to returns. So, on to what happened yesterday. I think it was, I thought I was going to speak about the key highlights from the budget today, and unfortunately there's no budget to speak to, but there are some highlights. So firstly, I think you can look at it as in a good way and a bad way, and I think we always want to see both sides. So firstly, I do think it is a real positive that the DA and some of the other parties finally said, this is a line you will not cross, this is where we will put our foot down, this is where we will threaten the entire GNU, and I think it was right. Clearly, if you have a deputy finance minister role and they don't tell you about a 2% planned VAT increase till the morning before the budget, this is just insane. It's clearly then a scam that you've got a deputy minister. You can't run it like this. So it's shocking that the ANC tried this. It's right that the DA pushed back very hard. So you can say it's positive and maybe it leads to a new era of cooperation if I want to put the optimistic hat on. Unfortunately, the really bad, and for me actually worse than the good, is that none of the economists that we read predicted that there was a 60 billion rand shortfall in the budget that we would have had to fill by a 2% VAT increase, because that's roughly the size of VAT increase. So, I mean, that's just a very material hole, and it obviously means that maybe revenue collection is a little bit less than what SARS hoped for, and probably expenditure and salary increases are running higher. So the thing is, even though we're happy now that they didn't go ahead with it, we still got to find the 60 billion in the next 3 weeks. So maybe they come back and they do a 2% VAT increase. Maybe they do 1% VAT and then some other personal taxes or corporate taxes. Or maybe the best case scenario would be obviously if you cut government expenditure and say we're actually going to try to shrink the labour force. We've already got the wage agreement, so we can't adjust that, but maybe we can adjust the labour force. I think that'll be the best outcome because we know how inefficient government expenditure is. But either way, I don't think there's any way for me that this is a good thing that we've got a 60 billion hole we've got to deal with. And the other major worry I have is our debt's high. The current deficit's forecasted to come down from 4.5 to 3, But the only reason it's coming down is because they are assuming they can stop the COVID relief grant, which is 35 billion rand per annum that they started in COVID. Now, they thought they were going to stop the COVID relief grant the year after COVID. Then they thought they'd stop it in year 2, year 3. It's year 5 now. If you haven't been able to stop it by year 5, people are now hooked on this. How are you going to stop it in year 6? I think it's insane that they assume they can take this out. So clearly, that's still going to be there next year. So it means next year we've got to find another 35 billion if we want to meet the deficit targets they hope for. So it's just not a good situation on the SA budget, and I think this does impact one's view on SA. And we spent most of yesterday afternoon debating our SA exposures, our rand dollar positioning, our bond positioning, and if there's questions, we can maybe get into some more detail on the panel. A little bit on where we see the SA consumer right now. It's also a debate we've been having in the office to say, what is the position of the consumer after the GNU? I think the market was quite buoyant in August, September, October last year, as everyone was saying this December is going to be just so big. We've got all this two-pot money coming to the system. The retailers are going to make great money. So the two-pot ended up being meaningful. It was 43 billion rands of withdrawals SARS have said they had. We think about 10 billion or so went to tax, so about 33 billion into the economy, which is a nice number over a 3 to 6 month period. That being said, November was strong. December did not end up kind of meeting the high expectations there was at the start of the fourth quarter. And you'll see from the retailers that reported, we got about a 5% total top-line growth for the fourth quarter. Certainly less than what people were hoping for. I think people were looking for high single digits, even double-digit growth. January has started very well, though, from the retailers where we have had updates, Pep, Mr. Price, Foschini. So it's a key thing for us to figure out, is there some anomaly with January where back to school was just particularly strong, or is there some real signs of life in the consumer? And I think our eyes are going to be kind of firmly fixed on this and figuring that out, because it will impact our retail positioning for the year ahead. So I don't have an answer, but I think it's an interesting one to watch for the coming few months. Now on to a topic I personally am extremely passionate about, and I think this is going to be the main thing that basically happens in our lifetimes. I think it's the thing that's going to have the biggest impact in the world by far of everything we see in our lives. I think that the key reason why things are happening the way they are is this thinking about Moore's law and then what that implies for AI. So Gordon Moore was one of the founders of Intel, and I think somewhere in the 60s, like 1965, around there, he noticed that the speed of computers they were developing and the speed of chips was doubling roughly every 18 months. So he made a prediction called Moore's Law that over the next 10 years, he thinks things will continue to double every 18 months. And amazingly, this didn't just hold for that 10 years, it held for the next 60 years. So what does that mean? 60 years, doubling every 18 months. It means roughly 40 doublings in 60 years. Now, every 10 doublings, 2 to the power 10 is 1,000, so every 10 doublings is 1,000 times. So like if you double 40 times, it's like a million times faster. So let's say the CPU in your phone is like a million times faster than 1965, what the best computer they could make, which is, let's say, the one we used to land on the moon. And that's why phones are so small, why computers are so fast, why you can do so much things with tech. Now, currently what we're seeing with AI is we're seeing 10 times cost reduction per year. So I mean, if we thought like doubling 18 months, like that built the whole modern world and all the tech we used, now like 10 times a year is like way faster than that. So if you double every 18 months, then you 10x like roughly every 5 years or so. So now we're 10xing every year, not every 5 years. And that means every year, AI will get substantially better, substantially cheaper, and there will be many more use cases. So I'm sure many of you play around with this. I mean, I love playing with it with my kids, and I think the last year especially, now that you can talk to it, they love it. So I try to ask questions with them like, why is the sky blue? Or like, why is it raining this whole week? Explain that to me, and it's actually pretty good at that. Obviously, they like to ask stuff like, if a T-Rex were to fight 10 lions, who would win? And actually, it's pretty interesting, the answers you get on these questions. It's pretty good at answering that, which is quite amazing. But on these companies we invest in, I think this shows you how excited these top companies are. This is the capex they spend largely on data centers and GPUs so that all of us can use OpenAI, so that we can use Google and all those things. And you'll see in 2024, this got ramped from like 150 billion to 220 billion, and they just all came out with results. And I mean, they're upping it again massively. So I think it tells you the companies at the front end of this curve are just super excited about this trend. And I think some of the things that's coming is OpenAI recently launched Deep Research, which is almost like an agent-type AI use case where you can tell the thing to say, go and research for me around some topic, like maybe some new industry you're interested in reading about or some interesting topic for your business, and do like an extensive 10-page research report on that. And basically what it does is it goes away for 10 minutes or 30 minutes in an hour, researches the whole web and gives you like a 5, 10 or 20-page report. And I think from everyone using this, the conclusion is this is about like a week's work for like an average researcher on a topic. So it's just spectacular. You can have a week's work of a kind of a human person be done in 10 or 20 minutes. And obviously that's where this CapEx is going. I just think it's going to open up so many more opportunities. I think the recent comments around Meta, which is our biggest holding in the space, they're now investing in potential robotics use cases, because I think as this tech improves and gets faster, you can embed it into a humanoid robot. So I think it's quite possible in 5 years' time, we might start having humanoid robots in companies or in people's houses that almost act like humans. It's just a very, very exciting time ahead, and I think it's a key part of our exposure for the year ahead. One thing we've learned is you can't just be excited about a theme and not look at valuation. So on this next slide, I thought I'd show you just kind of what we're thinking about in the valuation of these 4 shares we own. So we always look at what's the growth rate, what's the earnings growth rate of a company's, but also what's the current PE multiple. Is it fairly reflecting those growth rates? Is it too expensive? Is it cheap? So you'll see in 2023 and 2024, actually the sector as a whole grew roughly the same rate, about 35%. And at the bottom there, we compare that to the rest of the US market. S&P did -1% in 2023 and grew 7% in 2024. So you'll see we're growing way faster than the overall market. And I think the interesting thing is we think it's a bubble and we think these shares have run, but they've largely run because the earnings have come through. And I think if you see on the valuation, they're a little bit more expensive than they were a year ago, but it's not a lot more expensive than the market. They're like 20% more expensive than the market, but growing a hell of a lot faster. And if you think about these businesses, we think their revenue growth stays superior because of the AI use case expanding. But at the same time, AI is amazingly good at coding. Google's already saying 30% of our code is written by AI. I think Microsoft have said our programmers are 30% more efficient. So basically, you could have revenue acceleration, and I think potentially your costs could stay flat or come down as AI gets better and better at coding. So these companies are especially well positioned, in our opinion, to benefit from this trend. I think to close, it's really just an exceptionally exciting time ahead. And if you think back, like for most of human history, the future was at least somewhat known. If you lived in the 1700s or the 1500s, like you were probably a farmer, you knew your son was going to be a farmer or your kid was going to be a farmer, they were going to get married, have kids, and they were going to be farmers. Like you kind of knew what was going to happen over the next 20 or 30, 40 years. We are at a point in time in history where the future is by far the most uncertain it's ever been. It's really, really hard to predict where things will be in 20 years. Like, what will our kids be doing? Will they even be working? Will the AI do a lot of the jobs one day? It's that kind of uncertainty that's out there in the world right now. So it is an exceptionally exciting time, I think, to be an investor. This is the kind of stuff our team loves, like finding new things happening in the world, seeing new bits of information, figuring out what does this mean for the portfolio, how do we position clients' money to best benefit from this trend and to avoid the downside. So I think it's really a great time to be in a hedge fund and to have the flexibility and the tools we have at our disposal. So kind of, I'm coming to the end of the speech. I think one more thing to touch on is we invited Peter Steph to be with us kind of later today and to chat with David. And I think it's the reason there is our team is extremely competitive, all of us, and we love winning. And we thought Peter Steph is a key member of a team that's clearly very good at winning. And I think one could argue the team is the best in the world at winning. So it's really nice to be kind of associated with that. And I hope that's also an interesting time ahead. So what I'm going to do now is just invite David, Justin, and Alan to come up. Please send through any questions you guys have, and we're happy to cover that in the panel discussion. Thanks.